Hello, hello. I'm Diana Ransom, executive editor at Inc., and I'm very, very thrilled to be among these luminaries in the investing and startup community. So thank you all for being here. So here we are at possibly the biggest tech conference around, and I'm sure all of you are keenly aware of the global economic turmoil we face currently. I was hoping that you could kind of kick us off and sort of set the stage for us in terms of where we're at with, just generally global geopolitical politics and the implications for startups. It's a small question.
Just an easy question. As the person who introduced us before mentioned, deals are going down quite dramatically. He talked about 50%. The numbers that we have are around 30%. So fairly similar. The deal size are going down dramatically, 30% across the board, 50% for later stage. There is a bright spot. I'm sure we're going to talk about it in the seed, pre-seed angel world where valuations are actually still going up versus last year. But in general, there's been a lot of debate and very little action when it comes to fundraising. A lot of the VCs are sitting on the side and waiting to see what's going to happen and where the valuations are going to land. And when we look at the uncertainty that the war in Ukraine is creating, the challenges with inflation, the layoffs which are happening everywhere, the VC community right now is having a lot of soul searching, and I'm sure we'll talk about it. There is a big consolidation that is on the way in the VC world, and we will be in a very different world a year from now in the VC ecosystem.
Right. And so, Edith, I was hoping, Maëlle touched on this, but I was hoping you could also sort of give us a sense for the venture climate currently and a sense for prospects for exits.
Yeah, so to put things in perspective, I was actually to think about how you feel about it today compared to 2008, which is when the last financial crisis happened. That was also, 2008 was also the year when Satoshi published the first Bitcoin white paper. That was the year that the first Android phone was launched, and also the year that GitHub was born. So in some sense, sure, in the venture space, it seems like there's a lot of gloom and doom. But the reality is in 2021, $290 billion of venture funding was raised among all the VCs. And if you're as an investor, you're in the VC business, we have 3 to 5 years investment deployment period. Money is there. There's a mountain of dry powder. But it seems like there's a lot of gloom and doom because of the financial market crash. Certainly impact valuation, but I don't think that just Sequoia China alone, a few months ago raised $9 billion to invest in China. So there's a lot of things happening. On the exit side, I think that 2022 is definitely not a year for IPO. It's a year for M&A. Started with Elon buying Twitter for $44 billion. One of my portfolio companies, FTX, done 4 acquisitions this year, including buying 7.6% of Robinhood. Microsoft bought Activision for $69 billion. So I predict that 2023, this trend will continue.
Right. And Josh, give you a word in edgewise here. Give us a sense for, it seems like a lot of companies are tightening their budgets. And how are you changing things at Lux Capital as a result?
I'll give you a quick macro backdrop to that, which is agreeing with the 2 prior comments with one exception. The amount of dry powder, which does equate to about $300 billion, is really wet powder. A lot of that money is not going to go into new companies. A lot of that money is going to be for reserves of existing portfolio companies, as venture guys don't want to take write-downs. 15 years ago was the last crisis, but the real last crisis, as it's most appropriate here, is 20 years ago. And it was the web crisis. It was the dot-com boom and bust. And the reason why was that 15 years ago, it was mostly a debt collateral liquidity crisis. It was not an equity boom and bust. An equity boom and bust is something that is going to shock the vast majority of people that are under 37 years old. Because 37, you were roughly 15 years ago, 22, graduating from college then. You go back 20 years ago, you had mass RIFs, reductions in force. You had basically a psychological phenomenon that proceeded stepwise from denial, anger, bargaining, depression, acceptance, like the 5 stages of grieving. What followed that were the terms that investors gave to their companies. Right now, the number one thing that the vast majority of companies are doing, they went from, sorry, our round is closed, we're heads down, focused on developing product and giving the Heisman to investors, to now saying, we're actually going to open our round and do an extension of the last round price. Smart investors are saying, no thanks. Then they're saying, okay, we'll give you a positive inducement, we'll give you liquidity preferences, or participating preferred, we'll give you some equity kicker, some warrants. Smarter investors are still saying, no thanks. And then you're seeing pay-to-plays, significant down rounds, and ultimately restructuring. So I think the next 2 years are going to be quite brutal in mass. That doesn't mean that there won't be idiosyncratic companies that are extraordinary successes. What are we doing as a firm? 3 things. We call them bubble, anti-bubble, and consolidation. And I totally agree on the consolidation point. We're also investors in FTX and a bunch of our other companies from aerospace and defense like Anduril or in cutting-edge biotech like Icon. These guys have billions of dollars on the balance sheet. Enormous war chest of cash. They're going to consolidate their sectors because, as I like to say, strong balance sheets will beat weak cap tables. The 2 other pieces, which I call the bubble and the anti-bubble is now that the bubble has popped, you can get late-stage businesses because of these terms at early-stage prices. Free up management, help them re-equitize. Basically, late-stage investors that were in there earlier are going to get really screwed. The first and final piece, the bubble, is put them in a protective bubble. Give them 30 months of cash, 2.5 years, where they can be relatively immune from the volatility and the vicissitudes of the markets. They don't have to worry about Putin, Ukraine, China, Taiwan, resurgence of Donald Trump, whatever it is. Just focus on building and give them 2.5 years to do that in a protective bubble.
So, Maëlle, I know you have an opinion about down rounds. Can you share that with us?
Embrace it. I mean, look, the reality is a down round means that there's still people out there who want to invest in you. And I think that's the positive message in this current climate. It doesn't mean that you should accept any terms. I think, to your point, we see smart investors asking for more and more creative clause in their contract, and some of them, frankly, start getting into predatory territory. But in general, if you are in a position where you are being offered something that makes sense, that is a valuation that is aligned with the new multiples that exist in the market, you feel like the investors who is offering you these terms is someone that you want to get married with, or you want to continue to be married to them if they're on your cap table already, go for it. You will have some difficult conversation, very likely, with your employees in the first place, sometime with your previous investors, but most of them are going to be just very happy that you've been able to raise and embrace it. I know countless of companies. We have 3,300 companies in our portfolio, so I know countless of companies that went through a downturn and got to the other side in a much better, much healthier state.
And Edith, kind of similar, and along the similar vein, I was hoping you could offer some advice. Like, what are some tactical things that startup founders who are looking to raise money now should be doing?
Yeah, this year is definitely very different from 2021. Last year, you feel like cash is free. Now, capital is very, very expensive. So most of our portfolio companies, we encourage them to definitely cut costs. Make sure that you have at least 2 years of run rate. Please don't wait till you only have like 6 months left and then trying to raise money in the last minute, because it will take a lot longer. So for us, we're advising all of our companies, like if you have 12 months run rate now, make sure that you at least have 18 to 24 months. Having said that, this year is already almost $330 billion deployed, which is already more than pre-pandemic in 2020. And 60% of the activities are actually very seed stage focused. So even though it seems like it's harder, but if you're a great team, early stage, there's still tons of investors really interested.
And Josh, we were kind of touching on this a little bit backstage, but I know you were also speaking on a panel earlier about building factories in space and your fascination with GPUs, which is graphics processing units, I believe, which I did have to look up. What excites you? Like, where's the, the white space?
Yeah, so earlier we did a panel, Delian from Varda, who's also at Founders Fund, and they're great partners of ours, and he's got big ambitions to be able to not just benefit from the low cost per kilogram of launching stuff into space, but figure out what is high value dollar per kilogram that you would actually bring stuff back down, whether that's cutting edge fiber optics or pharmaceuticals. On the GPU side, the interesting thing was probably about 6 or 7 years ago, one of our cutting edge companies in autonomous vehicles was using simulators, and I walked in and we had put about $25 million into one of the first round, and I was like, what the heck are these guys doing? They're sitting around playing video games, wasting our money. And he said, no, you don't understand. Outside, these people are testing cars and they're processing LiDAR and vibrational sensors and thermal sensors and optics, and they're processing it at a rate of 1 second per second, reality. Inside, they're doing thousands of simulations per second. I said, well, what are these things running on? They said these GPUs from these two guys over there from NVIDIA, they're not even on the market yet. And that dawned on me at that moment that this was the soul of the new machine. Fast forward, and indeed, it is the processor. It's really taken over Intel ARM, everything from mobile to server side, for processing the cutting edge ML ops that are driving most of the things. The hype today is probably in generative AI, things that you're seeing in DALL-E, Midjourney, and Stability Diffusion. That's for the static art. We have a company, Runway ML, and it's incredible. It's actually the progenitor of the stable diffusion model. The V1.5 was just released. The ability to democratize creativity. I can't draw. I can't do vector graphics. I'm pretty good at putting in a text prompt. And that text prompt, the more descriptive it is, not only can I do static images, but I can do dynamic videos. So Runway ML, I think, is a winner there. Hugging Face, which started as a bunch of French PhDs that we won the deal on a rooftop in Brooklyn, is the repository for all these models. And they're all being driven by GPUs in the cloud. So Google, Amazon, others, Cloudflare is the CDN processing this. There's an entire infrastructure layer for all of the stuff that is basically taking the workflow of creative people to turn text into anything, from audio to video to images. It's really mind-blowing at the moment.
And what's potentially overexposed?
Well, there's areas that I'm very skeptical about. Almost anybody that's funding stuff in Fusion, anybody that is funding certain stuff in 5G, there is a lot of hype in AI. Anything in quantum computing usually gets my ire. And the reason is that there's an ignorance arbitrage. People don't want to admit that they don't understand what's being pitched to them in some cases, and so they part with their money. And I just think that there's an enormous amount of fraud in those sectors. So yeah, I would stick to some of the more mundane things like manufacturing in space and stay away from fusion.
Sounds good. And Edith, speaking of things that were potentially overexposed, crypto was on a major tear in the last year. I mean, it seemed like I was getting a new pitch about a new crypto company like daily, if not weekly. It was a lot. So what do you see on the horizon for this category?
So the state of crypto is right now is a little bit shy of 1 trillion in terms of combined market cap. In January 2018, when I invested in Solana, it was actually a lot worse, about 300 billion. And then in June 2019, when I invested in FTX, it was about 250 billion. So it's 1/4 of what it is now. So in some sense, sure, it seems like there's a lot of negative news, but I'm actually quite hopeful because the way that I look at the market now, by the way, just today, Facebook, Instagram now integrate with the Solana wallet, that you can actually sort of display your NFT in Instagram and be able to pay for all that. Yeah. That's exciting. So in some sense, I feel like the mass is coming and embracing the crypto market. And then on top of that, in September 16th, the White House now have a framework for—
Oh yeah, the AI framework.
That's right, like the protection digital assets, sort of the framework of how do you continue to develop virtual asset. This is great news, and I think like the financial oligarch from the Goldman or JP Morgan of the world are coming and offering Bitcoin ETF. This really just a matter of time. Is an asset class here to stay? A combination of various different government, including Hong Kong, supporting all this, and plus the way that I look at sort of the Ethereum Solana really is sort of the Amazon Web Services and Google Cloud of Web3. Mm-hmm. There's going to be more and more developer building on it, and it's just the beginning.
And Maëlle, from your perspective at Techstars, what are you seeing as like the next hot thing?
So again, back to the size of our portfolio, like this year we're going to do about 600 pre-seed investments. So we're the largest pre-seed investor in the world, basically. And we do that across 60 countries and pretty much any industry related to tech that you can think of. And we spend a lot of time basically like looking around to understand what's happening, what's booming. So from a geography perspective, while we remain largely exposed to the US, and we can talk about the state of innovation in the US too, what we've seen popping up on the map very strongly is Africa and to some extent the Middle East. Countries like Nigeria, Kenya, to some extent South Africa, and then in the Middle East, Egypt, UAE, Saudi are starting to do very, very interesting things. So I would definitely look at that beyond the usual suspects in Europe and in the US. And then from an industry perspective, again, like we play across any industry that you can think of. We have a ton of crypto. We have a space and defense program. So like we're all in it. The things that we are particularly excited about right now are food tech and agriculture tech. When you think about the combination of the supply chain disruption created by COVID and the war in Ukraine, plus the concern around sustainability and climate change, I think the Western world has for the first time started realizing that food security was not a given. And that has fundamentally changed the influx of capital in food tech and agro-tech. So I would definitely look a lot at that. Crypto, blockchain, Web3. Web3 definitely, blockchain absolutely, crypto we probably need to have another conversation. But I think the technology in itself, the blockchain technology and the new approach to the internet that is Web3, same thing, we're very focused on that. And then the last thing I would mention, there's a lot of application of health tech and ed tech, which are currently being developed for the developing world. And it's unbelievable, massive markets, really interesting innovations, and really innovative adaptation of what has been developed in North America and in Europe to countries that are going to leapfrog a lot of the hurdles. So I'm very bullish on that too.
And Josh, as you know, we're looking at a field of entrepreneurs out here. What's some advice to folks who are looking to get your attention or the attention of venture capitalists?
Well, I think in the current market, there's a few things. One is if you are raising money, raise as much as you can, husband that cash. Don't spend it on growth. Instead, spend it on consolidation, some of the consistent themes you've hit. Buy up your competitors, buy up your talent, buy their channels to market, their technologies, their customers. Second thing is the shift in the zeitgeist has gone from what everybody calls FOMO, fear of missing out, to what we call SOBs, shame of being suckered. Nobody wants to pay too high a price. Nobody wants to back a fraud, or at least wittingly so. And so what it comes down to for me, for entrepreneurs, are two things. An incredible ability to tell stories. And it's a benefit if they're true stories, but to be able to be a storytelling primate, it's the thing that gets us to part with our money. It's the thing that gives us the conviction that you're going to be able to hire somebody and get them to move across country or across the pond to be able to raise future money and de-risk it. And the last thing, which we always look for, and it's something that can't be learned, it's sort of innate, but the best entrepreneurs all have it, and it's a chip on your shoulder. People that come from various backgrounds where they have something to prove, they might have been the only minority in a mostly white neighborhood, the only female in a mostly male-dominated business, had a lisp, had a deformity, came from a broken home, whatever that situation is, chips on shoulders, put chips in pockets, and we love to see it in people.
Definitely agree with the good story. That also helps you land in Inc. magazine, too. Thank you all so much for your time today. This has been very insightful.
Thank you.